Good morning, everyone. Hope you can hear me. A very warm welcome to the second Sanlam Umbrella Fund Investment Feedback Session for 2023. So on our agenda this morning, we have a short economic overview from Solly Thier and Arthur Camp. Thereafter, Solly will take us through the performance, not only of the default investment strategies, but he will look into the member investment choice portfolios. Solly will then hand over to Wouter Derksen and his panel to discuss the two-pot and give us the latest on that, and also discuss an investment perspective for that. And in closing, we will invite Nizwa Shoniwa to the stage. Just a reminder for you all, we will record this session and we will make it available afterwards and post it on a link. You are also very welcome to ask questions in the Q&A toolbar. We will try and cover those during the session, but afterwards we will also make it available. So without further ado, then I'm going to hand over to Solly and Arthur. So thank you very much again for attending and spending the time with us. Thank you, Solly.
Thank you, Marie. Welcome, everyone. I will be providing you with investment feedback on the portfolios as Marie has mentioned. But first, let's have a look at what's been happening in the economy, as what happens in the economy affects investment returns and by members. And for this, I'd like to welcome Arthur Camp, who will be providing us with a brief but insightful economic update. I will then ask him a few clarity-seeking questions thereafter. But just to introduce Arthur, he's a chief economist at Sanlam Investment Group. He joined the Sanlam Group in 2005. He's also been an external moderator at the University of Stellenbosch for postgraduate financial analysis module in the Department of Economics. Arthur has extensive experience that includes him being an economics consultant at Eskom from 1990 to 1995, and then thereafter spending 10 years as an economics at a stockbroking firm, Simpson McKee. Arthur holds an honors in BEcon economics with a cum laude from University of Stellenbosch. Welcome, Arthur.
Thank you, Solly, and hello, everybody. So I thought we'd start off with the first slide showing you the rand. So yes, all the news obviously was yesterday with the mini budget, and we'll get to that in a minute. But I just wanted to start with the rand because this is something that tells you a lot about an economy. If you start analyzing what is driving a currency at any point in time, it tells you quite a bit about what factors are influencing economic outcomes. And one of them that's quite important to remember as we head into next year is tighter monetary policy in the US. The rest of EM and ourselves, we benchmark off the US risk-free interest rates. And we know that those tightening global financial conditions have fed through into South Africa, into the rand and our interest rates. The other thing is we've had a fairly sharp fall in commodity prices earlier this year. That's fed through. And then, of course, the one that we all know is electricity load shedding. You can empirically show that that's actually had an influence on the currency. So those are all negatives, and our job is to try and figure out how these pan out through the course of the next year, because that obviously, as Solly said, would also impact investment outcomes. The following slide will show that, unfortunately, over and above these factors that we can easily identify, these macro factors, there are others as well that are less easily quantifiable. And those relate to, for example, our grey listing. So if you look at some work done by the IMF, by Kidder and Petzold previously on this, they looked at a whole range of emerging market countries, and they said that it's quite common when you go on a grey listing that you then have large declines in net capital inflows before the listing and immediately after the listing, until such time as investors adapt and learn to the new about the new uncertainty and how to deal with it. There's often a lot of overshoot and volatility involved. So it's difficult then during this period to actually pin where the currency should be going. Needless to say, it would be very helpful if we got off this list at some point in the future. But for now, over and above those factors that I've described, at the end of the day, if you look at a currency, it depreciates over time in line with its inflation differentials if you're a small open economy like South Africa. One of the things that influences inflation, of course, is the mini budget and the main budget as well, of course, but fiscal policy generally. So if you look at my slides here, you'll immediately notice that I don't have the budget balances projected going forward that the Treasury came up with yesterday, and I'll explain that in a second. The Treasury is looking for, and it was a very bold budget. They've stuck to their guns in terms of expenditure restraint, and it's a very bold budget from that perspective. And they do show fiscal consolidation over the next 3 years. So they've got the budget deficit coming down from 4.9% of GDP this year, 4.7% of GDP this year to 3.7% 3 years out. That's the main budget deficit. But that deficit for this year is larger than the original budget of 3.7. And the reason for that is commodity prices declined, the economy's performed weaker than expected because of load shedding. And so we've hit profits, incomes are down, spending is down. And so obviously that feeds through into a lower tax take, and they've had to deal with that. And going forward as well, that feeds through into the outer years into a lower tax take as well. So they've had to do something about it. And what they did was they actually cut spending in a range of areas. And if you look at main budget non-interest spending, they cut around about 88 billion rand over the next 2 years and this year together. So this year, next 2 years, these 3 years, they've cut by about 88 billion. However, unfortunately, in the background, we've got those unfavorable debt dynamics continuing to work. We've got this rising interest bill, high real interest rates we're paying on newly issued debt, on a very big, large stock of debt. And unfortunately, those interest payments are now going upwards. And the Treasury actually had to revise up its projections for interest payments. And that eats up 65 billion rand of those 88 billion rands worth of savings through this year and the next 2 fiscal years. So, we're at that point, unfortunately, where that is beginning to show up in the numbers, and it's difficult to deal with. So unfortunately, also because of the need to cut spending, if you look at the projections on a consolidated basis, the Treasury is only looking for increases of only 3.6% per year in current prices over the medium term in non-interest consolidated spending. Now that's below inflation. If you think inflation is going to be about 4.5%, we think the Reserve Bank manages to get inflation down there on a permanent over the next 3 years, then that's negative in real terms. Difficult to achieve given South Africa's socio-economic conditions. Also, social relief of distress grant only pushed out for 1 year. Could be longer than, I think it'll have to be extended beyond that. And also no additional provisions for state-owned companies. And I think that's going to come home to roost as well in the next few years. So, yeah, we unfortunately have to keep our debt, our deficit expectations wider than the Treasury. And so over the medium to longer term, we've still got this ratio going upwards. Big difference between ourselves and the Treasury is they've got it stabilizing in 3 years' time, and we've got it still continuing on upwards. So, if you look at the Reserve Bank, yes, they've made the point that part of the reason for high real interest rates in South Africa is fiscal policy. So important for the Treasury to come to the party here. But at least one thing that does seem to be the case is we have peaked in inflation for the cycle. Near-term temporary increase probably, but broadly speaking, I think the trend is now lower. And we do think in the medium term that the Reserve Bank can get to that 4.5%. And that's good news, because that normally is the point where you see the peak in interest rates and interest rates coming down. Now, if you think the Fed, like us, it might do another interest rate hike if it starts cutting interest rates next year, even though it's delayed, that would help ease global financial conditions, should help the rand, and should also help us pave the way to start cutting our interest rates, although it'll probably be later in the year rather than earlier. But that's good news for our consumer, along with lower inflation. Following slide will show that, yes, we know that the consumer's been under pressure for those 2 factors that I've mentioned. And if you look at the national accounts data, they are on a net basis saving less and gone back into dis-saving territory. However, there are 2 things I want to point out here. The one is, if you look at this left-hand chart, the household wealth ratio, reading off the right-hand axis, is very high relative to personal disposable income. And I'll show you, and the last slide that we'll end off with, I'll show why that has been the case. And even if consumers are dis-saving on a net basis, we must remember that net savings ratio that's calculated, that we see published so often, is after we've adjusted for premiums paid on insurance, whether that be non-life insurance or life insurance. And since the global financial crisis, that right-hand chart shows that those premium payments have remained quite stable as a percentage of personal disposable income. In nominal terms, personal disposable income growth has still been positive, and so that's fed through into continued positive life premiums. Of course, we did have the dip into fairly low single digits growth last year, but it seems to be a little bit better this year. And if you look at the next chart, what that's done is over time, people in South Africa have the following chart. Yeah, thanks, Solly. So people in South Africa have consistently contributed to pension funds over many, many years. And if you look at the left-hand chart, the reward they've got from that and reinvesting the dividends over a very long period of time, for example, in equities, you see that their financial assets have grown particularly strongly, but then also the interest in pension funds and insurers. And total assets of households is sitting just shy of 20 trillion rand at this point. It's about 6.8 trillion rand in 2022 for interest in pension funds and insurers. And you can see that consistent growth over time. And even as a percentage of household income, rather than just looking at the absolute level in rand terms, we can see there since the late 1990s where the increase since then has been quite considerable, up to above 400% of personal disposable income, total assets of households. You, of course, have to adjust for liabilities, but even if you adjust for that, you've got just shy of 17 trillion rands worth of net wealth in households. So, it seems, yes, households are going through tough times. Yes, we are seeing that in terms of an adjustment in consumption spending this year. But I thought I'd finish on this slide because it's a slide that shows that persistence in saving and contributing to your pension assets over time stands you in good stead, and we can see it here in the growth of household wealth. Sonny, thank you. Those are.
So, I mean, I have a couple of questions to ask you, just 3 for now. Often economic conversations are incomplete without a little bit of discussion on load shedding. And I think everyone would like to know if, is it darkest before dawn, or are we having a lights out party? Is this load shedding situation going to be sorted out soon, and also the impact thereof on our economy?
Sonny, I think so. If you look at one of the key reasons we've had load shedding is Kusuli and Medupe units being out, over 4,000 megawatts at one point earlier this year. And we're slowly starting to see those units come back. And the projection is for them to continuously come back. And a lot of that will be back in place by around April next year, I would think. 4,000 megawatts is 4 stages of load shedding. And then if you take embedded generation, solar and also renewables into account, it does look like we'll be in a lot better position next year. So earlier projections earlier this year by the government showed around about, I think, 10 or 12,000 megawatts between early this year and end of next year sort of coming online. Even if we get half of that or 60% of that, we'll be in much better stead. I do think that we might still get some load shedding next year, but if you have levels of load shedding of 1, 2, or even 3, the economy copes with that quite well. The problem came in this year when we got to stages 4 and 5. So on a relative basis, I think a lot better next year than this year. And if we have easier global financial conditions, if the Fed does start cutting rates and the SARB starts cutting rates next year as well, and we have lower inflation, I'm not saying it's going to be great. But off a very low base, things should look at least a little bit relatively better in 2023. So we expect a bit of a pickup in growth next year after what has been a very challenging year for growth this year.
Okay, thanks, Arthur. And just to bring the discussion closer to how members are affected in terms of the investment returns, what we've seen in the past is that expectations on inflation and interest rates have been driving what happens in investment markets, the returns that members eventually earn. And you saying that, we seem to be close to the peak or at the peak of inflation and interest rates. Going forward, what do you think these drivers will continue to drive investment markets, or these factors will change? Is there anything that you can tell us that you foresee?
So, Solly, so you're quite right. So interest rates are key to the valuation of all assets. And we have been in a period of rising real interest rates. A large part of that has been unsustainable fiscal policy. This year, some of the increase in bond yields has also been due to, obviously, US Treasury yields going up. We benchmark off them. That's been an important component. So again, that I want to stress that point. If we get some easing up on that next year, it would be very helpful. But the thing is, we need to return to a sustainable fiscal position so we can bring down that real interest rate meaningfully. If we look at yesterday's budget, the borrowing requirement, the gross borrowing requirement, remains quite large. 560 billion rand this year plus, 2 years out, 620 billion rand. Unfortunately, that crowds out the private sector. And of course, that demand keeps real interest rates fairly high. But at least at this point, I think that the intent of the Treasury is in the right space. One can certainly question whether we're going to hit those ambitious expenditure targets. But at least I think the intent is in the right place. It does show debt stabilization 3 years out. The jury is out on that. But I don't think that this leads to a sovereign debt rating downgrade at this point. And so I think at least that's a positive. We may, over the next year, it's possible that we start talking about first a change to a negative outlook, and we certainly can't continue along the same path of very low growth and a continuous rise in the debt ratio over time that doesn't seem to end, because that will eventually, unfortunately, lead to further downgrades. But at this point, I think we've done enough to stabilize that. So that's one thing we don't need to worry about at this point. Unfortunately, the thing we do need to look at carefully is taxes. So reading between the lines there, we're talking about 15 billion rands of measures to increase revenue next year. I guess that speak for we're going to increase some taxes. I don't think, we don't know what those changes will be. Don't think it'll be personal income tax at this point or VAT. Unfortunately, that does leave you with wealth and taxes on wealth and savings, or then the tax expenditures that get looked at. So this is something, a space we'll have to watch carefully as we lead up to the next budget, the main budget in February 2024.
Yeah, and I appreciate the balanced view. These days, everyone just is swamped in a lot of bad news. And I was going to ask you in your conclusion, anything that, members or people can look forward to in the economy. You've already touched on that, but maybe, what can we look forward to, what to be cautious about, and closing remarks.
So I think to be the area where we need to be cautious is the extent to which interest rates stay higher for longer in developed economies, and that will be directly linked to the stickiness of the inflation. We assume further disinflation next year, which eventually, we're not saying there won't be another little bit of monetary policy tightening, but we do think that should ease conditions through next year, and that is important. And locally, what would be very important is that we see the Treasury sticking to its expenditure targets, because that's going to be particularly important in terms of the long-term debt outlook and the outlook for real interest rates in South Africa. But at least I think overall, just because we're in such a low base this year, so depressed in terms of economic growth, high interest rates, high inflation, all of those are now dissipating. We seem to be in a disinflationary trend, as I say, maybe a little bit of a pickup near term, but disinflationary trend, close to or at the top of the interest rate hiking cycle, less electricity load shedding next year, and there are signs that slowly but surely we are taking the first steps on economic reforms. That continues then on a net basis. I'm not saying things will be great, as I say, but relative to this year, one I think would hopefully look forward to a much better 2024.
Thanks, Arthur. We appreciate your insights. And yeah, you're free to go now when I go and present the investment returns to members. Thanks. All right. Just to take on from where Arthur left off, we'll start with the asset class performance. So this is performance of portfolios and the returns. If you look over the short term, the month of September was difficult, and it was followed by, this is following another month, which was August, which was difficult as well, meaning that, for the past 3 months, equities fell by 3.5%. This is domestic equities, and this is bringing the year-to-date returns numbers for the local equities. So this is from the 1st of January up until the end of September. Domestic equities have returned 2.2%. And in general, domestic assets have underperformed. So South African assets have underperformed global assets. By way of example, for the year to date, global equities have done very, very well, and portfolios that have had significant exposure to offshore assets have also benefited. And then part of the reason for this outperformance was due to the rand weakening. So if the rand weakens, it means that the offshore assets returns will be enhanced, and many of our investment portfolios within the default investment strategy have certainly benefited following the relaxation of offshore investment limits. We did increase our offshore exposure. Over 1 year, the returns are still looking good. So across the board, we are seeing solid returns, and also over the 3-year period as well. Now, if you look at the performance of the different default investment strategies, just as a reminder, we have 2 strategies that are approved by the trustees. These are life stage strategies and also the protection strategies. And within the life stage strategy, the management forums or the joint forums can select which portfolios they would like to go in, particularly the accumulation portfolios. To start off with the life stage strategy, in the accumulation phase, members are invested in portfolios that have high level of growth assets. These are the likes of equities and property, because over the long term, this is where the growth in investment returns will come from. And the portfolios that can be chosen are Sanlam accumulation portfolio, Sanlam Blue accumulation portfolio, Sanlam passive accumulation portfolio, and also the Sanlam wealth creation portfolio. As members get closer to retirement, we want their assets or the value of the assets not to be volatile. So just to reduce those asset classes that tend to be volatile, equities and property, and put them in portfolios that can preserve or protect their values. So members closer to retirement are switched gradually into the Sanlam Capital Protection portfolio, which smooths returns and also protect returns during the period that's very close to retirement to preserve members' value. Now let's start with the accumulation portfolios. So it's pleasing to see that, over the 3-month period that I mentioned that it was difficult for investment markets, this portfolio did not participate to the full extent in the negative returns. And the way we see this is that the portfolio returned minus 2.2% and compared to a benchmark of minus 2.9%. It just means that the portfolio did not fall as much as the market has fallen. And then over 1 year period, over the year-to-date period, the portfolio is up 7%. And then over 1 year period, the portfolio is in fact outperformed the benchmark and also outperforming the benchmark over 3 years and 5 years. If you look at over 10 years, the portfolio is starting to close that underperformance that we see in there. Now we are observing a marginal underperformance. If we look at the Sanlam passive, outperformed over all those time periods that we show there. It's testament to how we are managing this portfolio. The portfolio is also doing very well relative to peers. The Sanlam Blue Lifestyle strategy, the portfolio, if you look at the year-to-date returns, has returned negative. It has 10 positive returns, 5.6%, and also positive returns over 1 year period and other periods as well. However, the portfolio has underperformed the benchmark over 1, 3, and longer term periods. If we look at, lastly, while we're looking at the accumulation phase, the Sanlam wealth creation wealth creation portfolio has done very, very well. And also, if you look at the period, the last 3 difficult months, it has fallen to a less extent compared to what's happening in the market, posting very strong returns for the year-to-date 1 year period. The returns looking good as well, and as well as over 3 and 5 year periods, the portfolio has done very well compared to competitors as well. So this is the competitors' numbers that we show there. Just to start with the Sanlam Wealth Creation portfolios sitting at the top for the year-to-date 1 year, 3 years, and 5 year periods. And also it's worthwhile touching on the Sanlam Wealth, Sanlam accumulation portfolio. So the portfolio did struggle over the long term compared to peers because we come from periods where markets have been moving sideways or downwards. We haven't experienced a period where there has been a strong outperformance of growth assets. And why is this relevant? It's because the Sanlam accumulation portfolios compared to its peers equities and property and the likes. That's why you see over the period of 1 year, the performance of these growth asset classes have boosted the performance of the Sanlam accumulation portfolio, and also for the year to date, where offshore has outperformed. In fact, Sanlam accumulation portfolio is one of the portfolios that has higher exposure to offshore assets. So over the long term, we expect growth assets to outperform the defensive asset classes. That's why Sanlam accumulation remains relevant for members who would like to maximize their returns over the long term. If you look at the member choice portfolios, Sanlam Umbrella Fund offers a range of portfolios, and these are of different risk profiles. The moderate aggressive portfolios on the other end of the risk spectrum. There's a list of portfolios, a comprehensive list, down to moderate, conservative, and also cash or money, like money market-like instruments. How have these portfolios done? So let's start with moderately aggressive portfolios. PSG has been topping the charts, as we've shown at the last investment feedback as well. Alan Gray also doing well. And the Sanlam Wealth Creation portfolio has also been doing well as well. You will notice that there has been some laggards, such as Truffle Balanced over the short term, the 1 year period. And what we like to point out to members is that investment performance goes in cycle. So the one period, one manager will be topping the charts, and the next period, the very same manager could be at the bottom of the charts. An example is Truffle Balanced, in the short term lagging its peers. But if you look over the long term, their performance is intact, they're topping the charts. But also if you look at something like a Sanlam Wealth Creation portfolio, which is a multi-managed portfolio by Sanlam Investments multi-manager, here you would expect a more consistent performance compared to peer rankings. If you look at that. And then now if we look at the moderate and conservative portfolios, SMM Moderate Absolute Fund has done very well across 1 year, 3 years, and 5 year periods. So this portfolio, participates on the upside when markets are running, and also try to protect or preserve members' fund credits on the downside. You can also see the portfolio, the performance of the SMM 50 portfolio, SIM Moderate Absolute portfolio, and other conservative portfolios such as MSMM 30 portfolio and the SIM Cash portfolio. Let's now have a look at protection strategies. This is for those joint forums that haven't chosen life stage strategies as a default, but protection strategies. We have 3 portfolios under the strategies. We have the Sanlam Monthly Bonus Fund. So the strategy is called Sanlam Secure Strategy. We also have the Sanlam Stable Strategy and the Volatility Protection Strategy. The Sanlam Secure Strategy is the most secure because the bonuses, this portfolio smoothes returns and also protects members' portfolios on the downside, so gives explicit capital protection. And also the bonuses declared here are fully vesting, meaning that once the bonuses are declared, they cannot be taken away. Sanlam Stable Bonus portfolio, also a very stable and also secure portfolio. It's a smooth bonus portfolio. The volatility protection strategy differentiates itself from the others in that 25% of the portfolio is invested into what we call Satrix Enhanced Balance Tracker. So this 25% is useful when markets run and you want to participate on the upside. It is also relatively secure, but less so compared to the other portfolios within the strategy. Now, the aim of these portfolios is over the short term to give you positive returns and stable returns, and over time to give you inflation-beating returns. And these strategies have delivered on that. If you look over 3 months, remember, we are coming from difficult 3 months, but these portfolios have given you positive returns. The volatility protection strategy giving you 1.2%, the Sanlam Secure strategy retaining 2.5%, Sanlam Stable strategy retaining 2.7%. If you look over the long term, this purple bar here across all the years represents inflation, and the bars are all above inflation, meaning that the portfolios have outperformed inflation, and so delivering on their objectives. Let's now look at the preservation phase. So we go back a little bit to the life stage strategy. So remember at the beginning, we spoke about the portfolios in the accumulation phase. In the preservation phase, members are phased into Sanlam Capital Protection portfolio. If you look at the performance of that, this portfolio has in fact outperformed inflation over 1 year, 3 years, and also over the long-term period. The numbers that are shown here in the table just shows you how much the portfolio has outperformed inflation by. We call them these numbers real returns. So over 1 year, the Sanlam Capital Protection portfolio has returned a real return of 4.5%. That's the magnitude that the portfolio has outperformed the inflation by. It's also useful to compare the returns of the Sanlam Capital Protection portfolio with its peer equivalents. And the return profile or the cumulative returns of cumulative bonuses of the Sanlam Capital Protection is depicted by this smooth blue line here. You will notice that that line is smoother than other lines or that of competitors. This simply means that the bonuses that are declared here are consistent, and the portfolio is looking to build, a strong long-term return profile by delivering, by declaring consistent bonuses on a monthly basis. So unlike other competitors, who would declare volatile bonuses, the Sanlam Capital Protection portfolio is able to differentiate itself by declaring very smooth returns. So why should members invest in this portfolio as they get close to retirement is that this portfolio guarantees contributions that are invested, which is very important, during the latter parts of members' retirement savings journey. And, unlike cash, this portfolio does participate in financial markets. So it will participate when equities do well, but also protects when there are adverse market movements. So you are getting best of both worlds. And this is because the portfolio's underlying portfolio is investing in things like domestic equities, bonds, and also international assets as well. So the returns earned by the underlying portfolio are smoothed by the portfolio manager, just to ensure that members can experience smooth return profile. Just another thing to point out, so why smoothing matters is that members do not typically choose when they retire. And we have given 2 sets of examples. One member retiring 1 year earlier. So if you look at a Soli who would have retired, we're giving an example here in March 2019, when things were looking good in the financial markets, and the performance of the smooth bonus portfolio compared to the green line. So the green line here that is a bit choppy is a typical market linked portfolio. So when things were good, it wouldn't have mattered in which portfolio a Soli retiring in March 2019 is invested in. However, moving 1 year forward, if a Danny retires 1 year later, it does matter. If Danny was invested, in a typical market-linked portfolio, Danny would have experienced over 25%. So that's more than a quarter decline in fund credit, and just happening before retirement. But if Danny had been invested in a Sanlam Capital Protection portfolio, this would not have been the case. So capital would Now I will hand over to Wouter Dixon, who is leading the panel on Two-Pot, taking an investment perspective on this. Over to you, Wouter.
Olive, thank you very much. Good afternoon, everyone. I really appreciate the privilege of hosting the panel discussion. On a lighter note, Dani, if I look at your retirement date, you chose the wrong year. So we need to take what you say with a pinch of salt. But on a more serious note, welcome Dani and Johan. So I'll be presenting, hosting the panel with two industry experts. Johan Prinsloo online, he's responsible for retirement fund administration and he heads that up. And then we have Dani van Zyl, he's the head of Smooth Bonus, the Center of Excellence. So welcome, gents, and nice having you online. I'm going to jump straight into it, and I'm going to start with Johan, the famous Two-Pot legislation. Let me ask you, can you quickly give us a brief overview of what that is and perhaps give us an update on the latest developments?
Thank you. Good afternoon, Wouter, Dani, and to our audience. So very briefly, the Two-Pot system introduces about 4 key concepts. The first one is that from, well, what now seems to be 1 March 2025, and I'll get to that in a minute, we'll have 2 new pots that our fund credits will be invested in. The first one is the savings pot. From this pot, you can make a cash withdrawal once per tax year. And then the second new pot is the retirement pot that you need to preserve until retirement. Remember, currently when you resign or you terminate employment before retirement, you can take your entire fund credit in cash. This will no longer be possible for money that's in the retirement pot from 1 March 2025. And then also importantly, our retirement savings up until 28 February 2025 will be invested in a new pot called the vested pot. And now this is, Wouter, if you can bear with me, where it becomes a little bit confusing. As you'll remember, back in 2021, we had something we called vested fund credits and non-vested fund credits. And very briefly, a vested fund credit is basically a provident fund, which means you can take everything in cash at retirement. And a non-vested fund credit is similar to a pension fund credit, which means that you have to use 2/3 of those money at retirement to purchase an annuity. Now, that distinction will still remain, and that is bundled together in the retirement pot. And we also know that on 1 March 2025, administrators need to seed 10% to a maximum of what was previously 25,000, but now proposed to be 30,000 from the vested pot into the savings pot. So, hot off the press, and some of you may have seen the news reports already. So yesterday, the 3rd draft of the Taxation Laws Amendment Bill was published, and I think the most significant change from the 2nd draft is that the effective date of the Two-Pot legislation is moved or proposed to be moved from 1 March 2024 to 1 March 2025, and it really gives all stakeholders in the industry, including SARS, Two-Pot properly. Because if we don't do that, then our members are going to suffer the brunt of that. So how it's going to work, briefly detail, the draft was published yesterday. On 21 November, the Parliamentary Committee on Finance needs to approve the bill, and thereafter we can be 100% sure that the bill will be legislated, which means the date will be 1 March 2025.
Absolutely. Thank you very much. Johan, you quickly and briefly mentioned the seeding component to it. So that leads me into the discussion and the question, Dani, that you can imagine people can then on the 1st of March 2025 access that money. So people are worried about, have there been engagement with regulators just to determine what the cash flow impact on all of that would be? Does that work or not?
Thank you, Wouter. I'll jump in on that one. So remember, under the Twin Peaks regulatory framework, our prudential regulators actually sits in the South African Reserve Bank. So the South African Reserve Bank have been reaching out to insurance companies, asset managers, and the like, just trying to figure out how much money is likely to flow out during the first 2 months. So our expectation, and it seems the Reserve Bank as well, is once two-pot comes in, and now since March 2025, you're likely to have very high outflows in March and April, the first 2 months. And their big concern is if there's any systemic risk for the economy and markets based on that. Now, our feedback was we work out that the amount seeded will be about 3% of our assets under management. Most of our portfolios have sufficient cash in them to pay that out, so we don't think it's not manageable. But one needs to be cognizant, once you've not paid the cash out, you need to refurbish the cash in the portfolio again. So we like to be selling liquid assets like local equities, local bonds. So people just need to be aware of it. It might have a slight market impact, but our feedback to the regulators is that we don't see a systemic risk. The biggest risk might actually be on the government side. As Arthur has alluded, they have big financing requirements, so they issue a lot of government bonds. And if you're not going in April next year buy a lot of bonds in the market, why would you go to a government auction and then buy directly from the government? So that's perhaps a concern that we raised and something they need to be aware of.
Right. Thanks, Donnie. So what we've established is there will be seeding, there will be enough cash flow available to withdraw. So Johan, back to you. How does that cash withdraw from the saving pot then? How will that work?
Okay, so we know it's allowed as a once withdrawal in every tax year. And this is important, it's per fund or per policy or contract that you have. So if you have multiple, for example, retirement annuity funds or policies, or you belong to more than one retirement fund, that seeding will happen per fund. We also know that up until recently, the withdrawal from the savings pot will be taxed. It was pay as you earn. I think there was definitely something about tax and the changes there, but I do think the taxation of that withdrawal will definitely not go away. The other thing is that most administrators, from what I've seen thus far, will levy administration fee. So that means that a once-off administration fee for that withdrawal. So basically what that means is that if you apply for 5,000 Rand cash withdrawal from your savings pot, it will be the net proceeds that gets paid out to you, being the tax and the admin fee. So the way, and I'm not going to go into too much detail because I know we're limited on time, but essentially we as an administrator need to make sure that we channel or get the application for the cash withdrawal from the correct channel. So we decided to develop both channels, and what I mean by both is that application for cash withdrawal can be made either via the employer or directly by the member. There are certain conditions to those two channels, but the short message is that both of those will be available.
Thank you. So Donnie, asking you, so I'm a member, I want to take my money out of the savings pot and I'm invested in a smooth bonus product. We know they can be underfunded. So perhaps explain the implication, asking insurance companies, what will that type of rule be like and what does members need to focus on?
Okay, thank you. So yes, because we're smooth investment returns and a smooth bonus portfolio, the pot of money I have in the background never ever ties up to what the member sees in their statement. When the markets are running, I hold back some of the good returns, I have a surplus. When there's a market downturn, I actually have a deficit on my side, I need to manage that. Now, where we pay out the guaranteed or book value is where a member doesn't have discretion. So normally where he leaves his fund, he resigns, he retires, or dies, or anything like that. The concern is with the two-pot withdrawal is that it's completely at the member's discretion. You can withdraw your money once a year, as Johannes mentioned, and you can choose to withdraw whenever you want to, even during a market downturn. So if we were to do that payout at book value, you would actually prejudice the remaining members in the portfolio, and that's something we're very concerned about. So we intend treating this two-pot withdrawal from the savings pot as a normal disinvestment. So that means at the lower book and market value, so the same rules as per normal disinvestment would apply for these kind of withdrawals.
Can I ask you to take it one step further? And just we now specifically make reference to smooth bonus, but what about overall liquidity? So specifically in a country that needs things like infrastructure investment that are illiquid, how does portfolio managers take that into account?
It's quite difficult. I mean, I think the first thing we need to recognize that we already have a lot of outflows on a regular basis from all of our portfolios, whether smooth bonus or any other market linked. The main reason for that is we have a huge percentage of members resigning or changing jobs every month. And then when that happens, majority of them actually take their money in cash. So our portfolios already have, I think, more cash in that portfolio managers would like. Added to that, yes, people can now withdraw the money from a savings spot, but at least the money in the retirement pot will be there until retirement and can't be touched. But it does mean that the portfolio manager, like currently, needs to have enough or sufficient liquid assets, like in a responsible manner, to pay for these outflows. So yes, I don't think it's going to change anything that they're currently not doing, but they would need to ensure that there's sufficient cash available while still balancing the need for getting attractive and yields on unlisted assets like infrastructure. So, as I said, it's a problem we already have, and it's a problem I think is unfortunately going to continue within the two-pot system.
And I assume portfolios with economies of scale will obviously help.
That will make it a lot easier, yes. And I think that's a benefit of investing via the big pooled investments like you have on our Sanlam umbrella fund. As much we have seen in the past, it's far easier to have liquidity in one of our default portfolios, which are significantly large, than one of the smaller member choice portfolios.
Thank you. So Johan, I want to ask you, so I'm a member and I invest in different investment strategies, and now I want to withdraw from my savings spot. Can I choose from where do I withdraw?
So perhaps first off, in the short term, all three your pots will be invested in the same investment strategy that you chose, whether it's member choice or trustee choice, or whether you're in a life stage. So there won't be different investment strategies for different pots for the time being. If I take myself as an example, so let's say my three pots are 50% invested in Allan Gray and 50% invested in Coronation. And a deduction needs to be made from my fund credit. Let's say, for example, I get divorced. Then the divorce amount that needs to be paid will be taken pro rata from the values of the Allan Gray and the Coronation portfolios. Similarly, if you make a cash withdrawal from the savings pot, again, in my example, 50% of that value in the savings pot will be invested in Allan Gray and Coronation. And if I withdraw money, the money will be taken out of those two portfolios pro rata the value of each portfolio. So the short answer is everything in our administration system gets recovered or allocated on a pro rata basis. And that is a fundamental rule that we apply so that we can keep the administration as simple as possible. Therefore, unfortunately, members will, like in my example, if I want to withdraw 5,000, I won't have a choice to either take it from the Allan Gray or the Coronation portfolio. It will be taken pro rata.
Right. Thank you. So, Johan, you explained the practical administration implications. So, Dani, can I ask you lastly, so what are the main reasons that Sanlam believe that all these different pots we have should actually be invested in the same way?
I think the main reason is that we believe the main reason for saving for retirement and putting money in a retirement fund is also to get your money there at retirement and save for retirement. If you now have a different strategy, it can lead to suboptimal outcomes. Let's use, for example, some members some people in the industry who believe that the money in the savings pot should be put in cash. Now imagine you're not contributing to the different pots, and a third of your contribution gets put in cash the whole time, and you never withdraw it. Then this cash pot will build up over time, and cash returns are not that high. So it'll be a big drag on your total return if you have something like that. So we have the opinion that all three pots should be optimally invested together for retirement and to get you to a good retirement outcome. A second more, I think, practical problem is if you now have different strategies, different pots, and the individual strategies are not on their own Reg 28 compliant, how do you manage a member to be Reg 28 compliant when some people have, withdrawn from the savings fund, some people have not withdrawn? So each member would look differently. I think that will just be an administrative nightmare. So those are the two reasons. One is, I think, of course, it leads to better outcomes if you put everything in a more optimal strategy, but also there is a practical angle to it as well.
Thank you very much. Johan?
Yeah, sorry if I can just add to that. You know what? Just imagine that you now have to choose an investment strategy for each of your pots. It's already a complicated world we're living in. And if you add that complexity on top of everything else, I think we are going to confuse our members, and it's really not going to add that much value at the end of the day.
Agreed.
Thanks, Walter. Back to you.
Thank you very much. So I want to thank both Dani and Johan for your inputs. Really appreciate that. Thank you very much. And then I want to introduce Nzwa Shoniwa. He's the Managing Executive for Sanlam Umbrella Solutions, and he's going to conclude the afternoon for us. Thank you very much.
Hey, morning everyone. Just checking that I've got control of the slides. Excellent, great, thank you. I think firstly, it's a big thank you to all the presenters as well as the investments and marketing teams for making this session possible. From my side, hey, trying to get to the next slide. There we go. Now, yeah, I guess an important theme that has been raised by our partners, which is yourselves, is the question on our role with regards to the ESG discussion. Specifically questions on, how the fund can assist members with regards to their investment decisions as they relate to sustainable investing. So how does the fund incorporate environmental, social, and governance considerations as part of their investment principles in a meaningful way? Now, this matter was considered by the board for some time now, and the decision was taken to include BBB ratings and initial ESG ratings disclosures in respect of the investment menu held by the fund, which Solly took you through earlier in his presentation. And this is excluding the smooth bonus portfolio. So now these disclosures came into effect on the 30th of June 2023. Now, I think the one point I'll make here is that the board is fully aware that the ratings methodology that's being used would have to be refined and improved over time just to look beyond the quantitative aspects that we've looked at. But however, we do feel that, from our side, this is a step in the right direction in empowering our members as they make decisions that ultimately affect their retirement outcomes. And would also obviously welcome, comments from yourselves, our partners, in terms of how we can further, refine our value proposition and what meaningful information we can share with yourselves as well as the members. And in addition to this, which you'll also see on the slide in front of you, is that, most of you would have also heard our announcements that the Sanlam Umbrella Fund will also be making the Sanlam Living Planet Fund available to members as a member investment choice portfolio, effective 1 October 2023. Now, this fund is managed by Sanlam Investments in collaboration with and supported by the Worldwide Fund for Nature, the WWF. Now, the fund aims to provide long-term investors with acceptable financial returns within a framework that enhances environmental sustainability by redirecting investment flows towards sustainable opportunities and away from unsustainable practices, in line, with the whole discussion around ESG. Now, given the whole environmental sustainability objective of the fund, certain exclusions, constraints, or preferences will apply, especially in areas impacting climate change, water resources, and biodiversity. And again, from our side, looking at where the world is going, as well as discussions that we have with employers, partners such as yourselves, I think, these are the questions that are being asked, of ourselves from a sponsor perspective, as well as, of the trustees. And this is, sort of the steps that we've taken to try and address some of those questions and requests that have come through from yourselves. So from our side, to our intermediaries, members, and employers, thank you for your support and your loyalty. All of us here at Sanlam Corporate, and also on behalf of the Sanlam Board of Trustees, we wish you peace for the remainder of this year. I think lastly, if I could ask you to please remember to complete the poll that's going to pop up on your screens shortly. But thank you very much, and enjoy the rest of the day and enjoy the rest of the year.